Good Wednesday morning, Market Chameleons, and all those joining us for the first time. Thanks for coming by and checking out the Market Chameleon Market Show. This man, Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor. Call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
Yep. I'm going to share my screen. And as a note, for anyone joining us for the first time, Will and I, we do the show in the mornings to help answer any questions you may have about the Market Chameleon tools, the data or analytics. You could come on a show and ask your question live. We provide a link to Zoom. Click on that link. Once you get over to Zoom, click on raise your hand. Once we let you in, you could ask your question directly. If you prefer to type your question, you can type that question into the live chat on YouTube. Will's watching it. He'll read them back to me. While we're waiting for more people to join us and for questions to come in, we'll start out taking a look at the pre-market report, see if we could get some insights on stocks that are trading in a pre-market hours. Then we'll move on to the questions. All right, sound good, Will?
Yep.
So pre-market report, these are stocks that are trading in the pre-market hours. Let's first scroll down to these three tables over here, and you can see we have our most active stocks, our biggest percentage gainers, biggest percentage decliners. Here I see 38 stocks made our percentage gainers list, 75 made our percentage decliners list. So right now we're looking like we're setting up for a bearish bias at the open. I'm also going to scroll up to here. We have this calendar view. And on July 5th, which is today, we see these. This is a view from the top level of what's going on in the pre-market. So we have 303 stocks that are trading higher than the previous trading day's close. And then we got 507 stocks lower. As far as volume goes, 121 million shares are trading higher, 46.3 million shares trading lower. And if we convert that volume to dollar value, we have $577 million worth of stock trading higher versus $2.1 billion worth of stock trading lower in the pre-market hours. So that also is indicating from the top level that we're setting up for a bearish bias at the open. I'm going to come back down here to these tables. And when we look at the tables, you will see that a lot of stocks in here are lower cap stocks. These are the market caps. We have ETFs in there, leverage products, pretty much any security that's listed on the major US exchange. If it's trading in the pre-market hours and meets our thresholds, it'll make this list. And let's narrow down this list to a smaller group of stocks. And we'll use the filters here above. I'm going to use this one in ETF. Click on that. You get a drop-down menu. And you see that there's a list of ETFs to choose from. That top one, SPY, that's the S&P 500 ETF. When we click on that, the list below gets filtered by stocks that are holdings in that ETF. So in SPY, these are the S&P 500 constituents. And here we got 2 stocks that made our percentage gainers list and met our thresholds, and 6 on the decliners. So here we're also looking like a slightly bearish bias at the open. The lists aren't huge, but nevertheless, it's looks like a bearish bias. So we got like a couple minutes into it. Well, if we have any questions, I'll take those now. Otherwise, we could kind of just move on and discuss some other features on the website, or I'll default to some questions we get from emails.
That's perfect. You can move on.
Okay. Um, let me go to, maybe let's do the SPY. And actually, let me address some questions we have about, valuation. With a lot of places you'll see, either theoretical values or historical probability of win. And sometimes, like, I'll get questions, well, how exact are these, how accurate it is, and so forth. So when we talk about financial models, right? Let's take a financial model here. Right? You could have, valuation models. You could also, try to calculate odds or probabilities and so forth. And in these financial models, right, we need, what we're gonna do, we're gonna have inputs, assumptions that are getting fed into the models, and then the model creates an output. And one of the hardest things to build are models, on stocks or bonds or any finance, because you're dealing with lots of unknowns and lots of assumptions, and you have these data points, and you also have to figure out what data points do you include, how do you clean the data, and so forth. So all these are models that people are using, competing, and making estimates, right? And in a financial world, not just in the stock market, but you have it in insurance business, credit cards, you're always building these models, and the models are trying to either answer a question based on, what you're inputting, or trying to give you some kind of an estimate or baseline to make a decision from, to make a more informed decision. So there's no way, to say this is the exact value of Microsoft, right? Or this is the exact value, because everybody is putting in different inputs, different future assumptions, and so forth. So you're trying to create a baseline, maybe to answer, for example, based on today's market valuation in Microsoft, and given, the valuation versus its current earnings, I could try to create a model assuming that this is the growth rate the market is pricing in for the next 5 years to make this valuation make sense, something like that. But when it comes to, let's just take, for example, an option, right? When you're putting in certain historical data, well, what data do you use? How do you clean the data becomes important. Do you use 1 year of data, 2 years of data, 10 years of data? And those will give you different outputs. And that is subjective. Different people will have a different opinion, just which data to use and what's relevant. One person may say, I need all 10 years of data because I think that data from exactly 10 years ago from today is just as relevant as yesterday's data. And then other people say, look, what happened 10 years ago is no longer relevant. We had a different market. We had, lots of other variables that have changed so much that what I'm trying to model out and price out, that including that data will just make my output noisy, and it will give me less reliable results. Okay. So just even something simple like that, choosing the data will give you very different results, right? Let's say I'm trying to price out, volatility in the next 20 days. Well, if I look at historically, I could look at what is the volatility of a stock in the last year, but within that year, there are times, let's say, that the stock reported earnings. Well, if I include those dates into my model to try to project, the next 20 days, and if the stock isn't going to report earnings in the next 20 days, well, the model itself doesn't know what you're trying to do, right? It just gives you an output. So you're gonna input something, it's going to give you an output, and you might be using it wrong, because now all of a sudden, it's assuming that the data that you put in is all relevant to the next 20 days. And you could see that, let's say Microsoft's not projected to report earnings the next 20 days. If you try to project it using historical volatility and don't take that out, your output's going to be skewed, right? Just like if you're trying to price out an earnings move and you include days where Microsoft doesn't report earnings, it's not going to be as relevant. So when we talk about financial models, there's no such thing as there's an exact value or exact odds, right? You're trying to use the data to answer certain questions. You want to make a practical model, right? You want to make a model that is giving you some kind of a baseline to make a decision. And you got to keep in mind that there are a lot of, I guess, what do you call them? Known unknowns, and then you got unknown unknowns. That going forward, there are things that we cannot, we cannot even predict what will happen going forward. There's going to be events that are going to be completely, surprise to us. For example, COVID was a complete surprise, and COVID broke all the models because no model ever seen that data. There's no model pre-COVID that was ever able to see data of what would happen and what would be the reactions and so forth, given those circumstances.
No one who ever bought a restaurant thought the restaurant could be closed by the government, right? For
Exactly.
like a long extended period of time.
Right.
And now when you go to, and people are still, I guess, buying restaurants, you've got to take that into consideration.
Now you're going to take it into consideration because you've seen it. But exactly like we were saying, prior to that, nobody imagined it, right? So those are, I would say, unknown unknowns, because or even kind of like the war in Ukraine. Nobody was imagining that would happen, right? Nobody thought like all of a sudden that would be that was an actual risk on the table until it actually happened. The assumption was, probably wouldn't. But then there are known unknowns, so for example, we might know, hey, earnings are coming up, right? So we know that the stock's going to report earnings, and they'll tell you, by a certain date, but we don't know what it will be, right? We don't know if they're going to, sell more cars or less cars, and we don't know if they're doing well or not doing well, and we don't know what they're going to say during their conference call. We have no idea ahead of time. We just know it's coming, right? But how do you model out something that you don't know what the actual news will be, but you do know that there's going to be news events? So all these things make modeling very difficult. And when you talk about modeling, there's going to be imperfect information, because there could be information out there that you don't even know about or see, and that's not, and if that exists, then, and it's not input into your model, then you're not accounting for it. There are going to be some biases involved because it's subjective, right? When you look at the data and you decide, what do I want to include in the data, to generate a theoretical value or win rate, that's also subjective, because you do need to make a decision. What data is going in? The model itself doesn't do it for you. You have to make that decision. And that could be subjective, because I gave you an example. Some people will just say, I don't care, put all the data in, and run the model. Other people will clean the data and say that doesn't make sense. I'm trying to answer a question, and based on my question, I need the most relevant data plugged into the model. So when I look at the output, it makes more sense to me. So very important when we deal.
Actually, Rob mentioned Nouriel Roubini, and he's one of the classic. He's anytime something dangerous is lurking in the market that people are talking about, they bring him on to talk about these black swan events and the possibility and how they can be affected, how the market will be affected, that type of thing.
Yeah, exactly. Because one thing we've seen from history is that, money panics happen. They happen throughout history. Something like a black swan or something happens, and that creates pressure on the markets, and they could go down really quickly, right? But trying to predict that swan event, or when it will be and what will trigger it, is not possible. There's no model that could say, like, on this date there's going to be a black swan event. You can't do that. We just know that throughout history they happen, right? We've seen even, we've seen, real estate bubbles, happen. We saw COVID happen, 9/11, the internet bubble. There were lots of instances in history. You could look back. We had the stock market crash in 1987. Then we had the Great Depression. The money panics, they happen, but it's not possible to say this is the date and this is what's going to trigger it. We don't know that ahead of time. We just know that they happen. So when we create these baselines and theoretical values and odds, and we're constantly trying to improve them, and you're tweaking your model as more data comes in and you evaluate it, but there's no perfect answer. There's no precise or perfect answer in financial modeling. Nobody has. If it existed, we wouldn't have so many different businesses out there trying to hire and model, and this is why it's so difficult, right? That is why it's so difficult for people to make a profitable long-term trading system, right? Because if it was just an easy and there was an exact answer, then it would be very simple, right? Then it would be like easy as pie. So financial model, you're making estimates. I'll give you an example. Like, I cannot predict who's going to win the Super Bowl next year. There's no way for me to know this, right? But I could start kind of modeling out the most likely teams, right, that might make it, and start giving odds. But as the season begins, and then you have more data coming in, then you kind of see, oh, well, here are certain players that were expected to do well, they're performing poorly, and then there are players you didn't consider all of a sudden are performing really well. then you got injuries and all this stuff going on that is bringing in new data, and you're tweaking it, and then you're updating it to real-time data and trying to produce, odds of what you think is most likely going, who's more likely to win the Super Bowl as you get closer and closer to that event. But there's no way of knowing for sure, right? That's what you're dealing with. You're dealing with estimates based on data. So that's, very, very important to understand. Financial model. No, nothing precise or exact or anything exists that way. You're trying to create a practical model, trying to answer some question based on the data that you're inputting. All right.
We did have one question. Well, actually, we had two questions that popped up before you got started on the financial model. Well, it was after. Unfortunately, there's a delay.
Yeah.
But, Rob was asking for you to going through. He's asking about the 0 DTE option scan and explain the parts. He's wondering if you could go through that again. I mean, we only have like a couple minutes left. Maybe tomorrow you can do the 0 DTEs again.
Yeah,
and talk about it.
yeah, and keep in mind, one thing is we are doing a webinar on the 0 DTE options next Tuesday at 2 p.m. with Interactive Brokers. So I'm going to do a more in-depth, detailed webinar or tutorial with them on that Tuesday. But if you do have specific questions you would want me to cover in that webinar, email it, because I'm going to have more time there and more organized. And then if there are questions left over, I'll start doing them on the show as well. But we are going to be doing that webinar that next Tuesday, right? Well, with Interactive Brokers, and you got to register with Interactive Brokers.
Yep, and I'll put the link in the chat, and obviously their emails going out all the time, but that is a registration that you have to do on the IBKR website. Sarush was asking actually at the same time about DTEs, but longer dated DTEs. He's questioned, what is your take on going further in DTE, which anyone who doesn't know, date to expirations, 90+ day when volatility is low, when it comes to selling puts? So I guess he's asking, what's your thought on selling puts in a low volatility environment farther out, 90+ days? Selling puts obviously is risky to black swans, like you were just talking about.
Yeah, it's like, it's really that there's no general answer to that question, because there's so many things around it that depend on all these variables. What is your outlook? What is your position? How do you fare if there's if the market goes down and volatility goes up, and do you have gamma? Do you have deltas, that you're going to have to cover? Do you have Vegas somewhere else? There's too many variables to answer that question. I don't think there's a general answer for that. Trading usually doesn't have a general answer to these types of questions, because these are trading questions that always, it's going to be subjective. Plus, it's going to depend on your outlook. It's going to and your position also. What is your position can dictate, maybe what you should be doing. So if you have a position on with lots of, if you sold lots of downside puts, let's say, for example, well, you already have that exposure. So selling more puts, you're just adding to the risk exposure, right? And if your outlook is very bullish, or these puts are going to expire, okay. But again, you're adding to risk if that's all you're doing. Some people, I've seen people who said to me, I just screen for selling puts, downside puts. That's it. Well, that means that's your exposure. That means if the stock market goes down, and if these stocks go down, your puts are going to be very, your puts are going to lose money, right? If the stocks starts going down violently, goes through your strikes, they're going to lose money if that's all you're doing. So it really depends on a lot of variables, and I don't think there's any general way to answer that question.
All right. Well, we're right up against the opening bell, about 4 minutes. Any last words?
Yeah, no, sir. Thanks for joining. I will start answering a lot, more stuff on zero DTE as we do that webinar. I mean, I know people are excited and enthusiastic about it. At that webinar, we'll answer more of those questions. And then after the webinar, I'll start also looking at him in the pre-market.
Actually, we did have another question. I almost forgot. I did kind of answer, but it was from Justin. He asked, have you ever thought of any plans for an app? And I said we're always thinking about doing different things in an app, maybe one of them. But I asked what features would he like, and he's like, the scan trade features is what he likes. But any comments on, have you ever thought about an app for Market Chameleon?
I mean, we thought of an app. The thing is, I don't think of it's, at least the way I don't think of trading as something like on an app. Maybe looking up information and doing some quick, quick references to things you could put in an app. But as far as like conducting research and looking through data and analyzing things, it would be very hard to do that, on an app or sitting at a restaurant and trying to do research on an app to make financial decisions. That's not the way, research platforms are built. It's like, certain applications, like take Excel, right? If you take Excel, you can't really do that on an app, right? There's too many things going on that to put on your mobile device and, really use it and utilize it and optimize it on an app. Sometimes you need a bigger screen, a desktop, to, fully utilize those features. So, there are apps out there if you just wanted to look up stock prices or look at a chart or something. Those apps exist. Ours just run more analytics, and I don't know how I would be able to do that on an app.
Yeah, it would have to probably be a feature.
It would have to be a certain features maybe that you can put on an app, that I think people like, but not the whole website. The whole website would not be able.
I mean, the whole website's on your phone. You can kind of check it out. I'm sure people have.
There's limited.
MarketChameleon.com. You can imagine trying to fit everything in. It's very hard.
It would be very, very hard to do it that way. Certain things you can put on an app, but not the entire website for sure.
All right, D, thanks so much. Happy day after 4th, everyone. Enjoy your day. Have a great trading day. Thanks, D. We'll see you tomorrow.
Thanks, everyone. Yep. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.